Night 2 of week 2 of real estate finance. We're almost done. Just keep going. Thankfully, we're going to have just a couple short videos tonight, and the lecture should be relatively short, so it shouldn't be too bad. To go ahead and get us started, I'm going to play just a supplementary video about mortgages. This gives not an in-depth view into mortgages, but it kind of goes into more detail than we do in the class, and just kind of gives you a better, more broad understanding of all of them. He does a really good job explaining it, going into all the different types and how they are processed. So we'll go ahead and start up with that.
Welcome back to Whiteboard Finance. My name is Marco, and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about the ultimate guide to mortgages, aka Mortgages 101. So a home mortgage or a primary residence mortgage is typically the longest and the largest loan that most people take out throughout their entire lives. A lot of people have basic understanding of what goes into a mortgage, but the more and more I interact with people on social media, in my DMs, or just on Twitter, for example, I can start to see that they don't really understand the entire inner workings of a mortgage. So in this video, we're going to talk about the 4 factors that go into a mortgage payment. We're going to talk about the different types of mortgage products out there. That way it can best suit your needs to know that you're getting into the best product possible. I'm going to take you through a live demo of my own home affordability spreadsheet. That way we can mess around with the house price, the down payment amount, the insurance, the taxes, all that good stuff. And I'm also going to take you through a live demo of an actual amortization schedule between a 15 and a 30-year mortgage. Let's get into it. Okay, so very quickly, let's run through the 4 factors that go into a mortgage payment. If you understand the acronym of PITI, that simply stands for principal, interest, taxes, and insurance. If you're a real estate investor, you know these 4 letters like the back of your hand. If you don't, let's run through these very quickly. So P stands for principal. This is simply just the amount of money that you owe the bank for lending you to be able to purchase the house that you're moving into, okay? So the example that we're going to be using for this video is a $350,000 house, and we're going to be putting 20% down. So in the comment section below, tell me what the down payment amount is if we're putting down 20% on 350, and what is the mortgage amount going to be. You can pause the video here. Okay, so if you answered $70,000 for the down payment and you owe $280 on the mortgage, that is the correct answer. So moving on, what is interest? Interest is simply just the rate at which you are borrowing the money from the bank. You're paying the bank to borrow their money. That is how the bank is compensated, okay? So the higher risk you are, meaning the lower credit score you are, the higher the rate that the bank needs to make in order to compensate themselves for taking on risk, aka you're going to get a higher interest rate on your mortgage. So higher risk, higher rate, lower risk, lower rate. The better your credit, the lower this interest is going to be. So I'll show you how that affecting the interest numbers actually affects you in the long term in my spreadsheet later in this video. T is taxes. This is a no-brainer. So property taxes are used to help fund schools, infrastructure, government workers, things like that. That is why property taxes are a part of owning a home. So these taxes are typically calculated on the assessed value of the home, and the lender can actually roll these into your mortgage payment. They're going to be escrowed, meaning they're going to be set aside in a special account, and once they're due, typically twice a year, that's going to be paid to the municipality that they're owed. So this taxes will actually get rolled into your mortgage payment in most cases. And then finally, we have insurance. So insurance sounds just like what it is. Property insurance is if a tree falls on your house, it's just like car insurance. You're going to get compensated after some sort of deductible, okay? And you pay for it monthly typically. However, there's this other thing down here called PMI, which is private mortgage insurance. So typically, if you put less than 20% down on a property, PMI, private mortgage insurance, is typically there to allow the lender to get some breathing room, if you will. This doesn't go towards the principal of your payment. It just allows the bank to be able to turn your property into a security and sell that mortgage to other bigger banks. And it also gives them a little bit less risk for taking on that mortgage if you don't have 20% down. Some cases, lenders will allow you to put less money down with no PMI, which we'll get into right now. Okay, so we have 5 different types of mortgages. There actually are a few more, which I'll list at the end of this list, but these are the 5 most popular, starting with fixed rate mortgages. So fixed rate mortgages, I'm sure you've heard this. This is what most people think of when they hear mortgages. These can be offered typically in 10, 15, 20, or 30-year increments. The most popular obviously being the 15 and the 30, with the 30 being the most popular overall. So this interest rate never changes. So if you remember the acronym PITI, Principal, Interest, Taxes, Insurance, the interest portion of this loan over the course of the term, it could be 10, 15, 30 years, that interest rate never changes. That's why it's called fixed rate. On the other hand, you have number 2, which is called the adjustable rate mortgage, or an ARM. So this has a rate that's fixed for a specific period of time, typically the first number here. So you have 5 years, 5 years. I'll explain that in a second here. It's fixed for a certain period of time, and then it adjusts over time depending on the second number. So for example, if we look at a 5-1 ARM, that means that the first 5 years is fixed, and then it adjusts annually every year after that. So these are typically based on the 1-year treasury bills or LIBOR. Okay, so if you don't know what LIBOR is, it's just an acronym for London Interbank Offered Rate. So if you want to look at an example of a 5.5, that's fixed for 5 years, and then it's also fixed for every 5-year period after that. It adjusts every 5 years after that. So this typically benefits people that don't want to have a mortgage for long, or they feel like interest rates are going to be going down. And if you've been following my channel at all at the time of this recording, you know how I feel about interest rates. Number 3 is the FHA loan. The FHA loan is insured by the Federal Housing Administration. This allows down payments all the way down to 3.5%. So when we talked about a 20% down payment, which is the example that we're going to use in the beginning of the video and also on the computer, this actually allows you to put down 3.5%. So say, for example, the house is $100,000. If you put 3.5% down on this, what is the number? Well, simple math tells you that it's $3,500 and you can get into this property, okay? This is typically for people with low credit scores. You're gonna pay PMI, the private mortgage insurance that we talked about, but it's a good way for people who have the lower credit scores and not 20% down to get into their first home. So 4th is a VA mortgage. This is just basically insured by the Department of Veteran Affairs. So veteran meaning, military, service people, that kind of a thing. The nice thing about a VA loan is that you don't have to have any down payment whatsoever. You can actually put down 0%, okay? So on a $100,000 house, you can put down 0, if that makes sense. You will have to pay a VA funding fee. It changes all the time. There's a table that I can link down in the description below. And there's also no PMI on this 0% down payment. So basically, the VA loan is a great way to get into a home with very little money down. Yes, your mortgage payment is going to be higher, which we'll go over in the spreadsheet, but you have very little money out of pocket, which actually allows you to potentially invest that difference. So this is a very good loan. And then 5th, we have the USDA loan. This is actually backed by the Department of Agriculture. Yes, that USDA. And basically, this allows you to get into a home with no down payment as well. However, you are limited to basically home improvement loans or purchase loans, but it has to fall within a certain income limit, certain geography limit, and then also there's a property value cap. So you can't be buying, mansions in the suburbs with this kind of a loan. It's typically more rural areas, okay? So this benefits people who want to live a little bit more rural and have a very little down payment out of pocket. And finally, there are 2 more loans that I didn't talk about, just because if you need these kinds of loans, you're typically, I don't want to say well off, but you're buying, pretty expensive houses. Or you're very disciplined with your money and you have a lot of cash. So that is a jumbo loan, and then also a interest-only mortgage. So if you want to learn a little bit more about those, feel free to Google that. But let's get into the live demo right now in the home affordability spreadsheet using our $350,000 house as an example. Okay, thanks for joining me in the second part of the video. We're going to go through my live home affordability spreadsheet right here. This spreadsheet is actually available for you to get for free through my newsletter. So if you sign up to the newsletter, it comes in 24 hours, or you can get it instantly if you become a patron. It's literally $4. It's the best $4 you'll ever spend, because this could potentially save you tens of thousands, if not hundreds of thousands of dollars, okay? So let's run through this real quick. So If you want to watch the original video where I use this, you can click on the link right here when you get the spreadsheet, or you can literally just refer to this video, obviously. So earlier in this video, we talked about this couple or this individual buying a $350,000 house, which you can see right here. They're putting down 20%, which results in a $70,000 down payment. That actually results in a principal loan amount or a mortgage amount of $280,000. So if you remember the acronym that we talked about with the PITI, that is simply just the P in that acronym. So moving forward, you can see here that the interest rate that we're going to use is 2.89, and we're also going to use that on a 30-year fixed rate mortgage. So typically the most popular mortgage that is used by people out there is a 30-year mortgage, and I'll play around with these numbers so you can see how everything changes. We're going with 12 payments per year, aka once a month, which results in a mortgage payment of $1,164. The interest costs over this 30 years, which people never think about, is actually $139,000. So let that sink in. If you pay the minimum amount over 30 years, your interest on this loan is going to be $139,000, resulting in a total cash outlay of $419,000 outside of the down payment. Okay, it's basically just the loan amount plus the interest gets you this number right here. Now, what most calculators don't take into calculation is that they don't ask you for the amount of taxes. So let's just take this home. Let's pretend like we're in a certain county that charges, X amount of dollars. Let's just call it $6,500 per year. Now, the insurance on this house, we'll just use 1,000 as easy numbers, and maybe a little bit more, depending on if you live in like a flood zone or a hurricane area, or if you're somewhere in the Midwest with tornadoes. I don't know, but we'll just use $1,000 for easy numbers. This is all editable. Let's assume that this house is not in an HOA. If you did have an HOA, you can bump it up right here, $25 a month, for example. If you're in California, here's 300. I'm just going to keep it at 0 right now. So now what this spits out is right here, you can see that this cell is incorporating all these numbers right here. And I'm just exploding that by double clicking it. You're getting mortgage, taxes, insurance, and an HOA monthly payment of $1,789. And I basically added $400 of utilities here. You can change that right here in the top left. You can make it 300. You can make it, 500. You can make it whatever you want. I just used 400 as a nice even number. And that's typically what utilities are where I live. Maybe a little bit less, but that's not the point. So anyway, this spits out two different numbers. You have everything all in right here. This is a majority of your housing costs. And then you have just the mortgage, tax, insurance, and HOA. Now, what we have over in columns G through I actually provided 3 different scenarios of person 1, person 2, and any potential income. So if you're a single person, you basically put 0. You make 50 grand a year. This is what the numbers look like. Okay, very simple. Let's just pretend like we have a couple here, and they both make equally $50,000 a year. This gives you a gross income of $100,000. This is where you can edit this if you want. The total net income, all these numbers are based on net income. This is where a lot of people get into a lot of trouble because they start going off gross income, which is not correct. Okay. So I basically took the gross income, multiplied it by 0.68, which you can see up here. And that is a fair estimation of taxes, insurance, all that stuff that comes out of your paycheck. No one really makes 100% of what their annual salary is, okay? So if you want to adjust that accordingly, you can do so in the top left. This results in a monthly net income based on these numbers of roughly $5,667. Now, the beauty of this is that you can actually see what percentage of the mortgage income, so you can see here with the mortgage, taxes, insurance, and HOA are taking up of your net income. And then you can see the second number with the all-in number with utilities. So you can see what pretty much your all-in housing cost is going to be in terms of monthly net income, okay? The nice thing about this is that it shows you what the monthly income is after your housing expense. So this is what these people have, monthly net minus the all-in with the utilities. And then the final row down here is actually saying, okay, you make 100 grand a year, but the house costs 350, so that's 3.5 times your income. Makes sense? And now the reason I provided 3 different scenarios is because what if you get a raise and the other person, changes their career and doubles their income, and you can just mess around with this, so on and so forth. The thing is, though, the reason why I'm showing you this is not to, just advertise the spreadsheet. I couldn't care less about that. is by showing you what interest rates and term and down payment does on a mortgage. So let's pretend that this is an FHA home and now we have 3.5% down. You see how this affects the numbers? So they put less money down, they have a higher interest cost. It's taking up a way bigger chunk of their monthly net income because they have less money down, and it's basically creating a less money outlay because they're only putting out 12,250, but they're also paying a lot more in interest over the course of those 30 years. And this is not accounting for PMI, which you have to add a couple $100 more on top of this. Now, let's take a look at someone who puts down, if you want to go crazy and you have just a big amount of cash, you put down 50% on this home. The down payment is 175, but it also gets you closer to 30% all in, and you pay significantly less interest over the course of those 30 years. Let's stick with our example of 20%, and let's just turn this into a 15-year mortgage. Let's keep the interest rate the same right now. You can see that we went from $139,000 in interest all the way down to 65 just by cutting the payments in half. And by payments, I mean term, excuse me. If you want to make this even more realistic, a 15-year mortgage right now is trading at 2.59%, which makes this interest even cheaper. However, look at the monthly income. It went from basically in the 30s to 51% of your income when you're accounting for the utilities as well, leaving you with only $2,700 a month to work with. So this is a pretty cool spreadsheet. The reason I'm showing you this is because I just want you to actually experiment with this and see what fits within your budget. The typical rule of thumb that I like to go off of is your all-in housing payments shouldn't be any more than 30% of your net income. And when I say housing payments, I'm talking about everything. I'm not talking about just the mortgage. I'm talking about, excuse me, my hair is falling apart here. I'm talking about everything: mortgage, insurance, taxes, utilities, HOA, anything that goes towards housing should be accounted for. Now, let's move on to, excuse me, an amortization schedule, okay? A lot of people, they don't really understand or study these amortization charts. So the first one we're going to do is a obligation of $280,000 on a 30-year, and we're going to go with our example of 2.89%. We're going to calculate this. So our monthly payment is right. It's $1,163. You can see here, you put 20% down on 2.89. It's $1,163, same number. So our chart is right. Over the course of 30 years or 360 months, and we owe $280 on it. Now, if you look at a 30-year mortgage, let me see if you can see this okay. Okay, looks good. On a 30-year mortgage, you can see that a majority of your payment goes towards interest. Although your payment is $1,163, only $489 is going towards the principal, meaning you're only building equity on $489 as opposed to $1,163. So why is that? It's because these mortgages are front loaded to pay more interest, especially on a longer term. And then you can see as time goes on, you can see your balance going down. The funny thing is, well, not so funny, but just the truth is that your principal payments only exceed your interest payments 6 years later in September of 2026. So let that sink in. You're paying more on interest all throughout the course of this loan for 6 years. Does that make sense? Now, let's see what happens if the same exact scenario goes to a 15-year mortgage. Yes, the monthly payment is going to be higher, as you can see there. However, you're paying more on principal from day one. You see that? So your payment is obviously higher. These two numbers equal 1,918, but a majority of your payment is going towards principal as opposed to interest. So if we go 6 years down the road again, just to make an apples to apples comparison, let's find September right here. You can see that almost $1,500 of this $1,900 is going towards principal as opposed to interest. Now, let's just get super crazy and say you took out a 10-year mortgage, okay, at 2.89. Oh, and I apologize, I didn't change the 15 to 2.59%, which is going to make that interest even smaller. So let's just call this 2.59 right now. Calculate. Boom. You can see that your payment is $2,600 right here. However, $2,000 is going towards principal and only $600 is going towards interest. So that's all I got for you guys today. I hope you found value.
All right, so I hope y'all found that helpful in a way, going over loans and and how they're formed and kind of the way they work. With that spreadsheet, I thought that spreadsheet was interesting that he was using and kind of going through and showing how different interest rates, different down payments, all that really affect the life of the loan. So today, chapter 7, we'll be talking about the real estate financing programs. Now, real estate financing programs, we're going to kind of talk about the basics. Starting off with interest. Can somebody give me now? I'll just, y'all know what interest is, obviously. Interest is, rent, basically on the money that you're borrowing. I really don't have to go much more into that. I had a bunch of stuff written down from earlier, but I'm sure y'all are all old enough to understand what interest is. The interest rate factor, now there's a lot of factors that go into when you're trying to originate a loan. There's many key factors that play into the role of what interest rate you get. Can somebody kind of give me, what they think are the main factors that play into the interest rate that you receive when applying for a loan? Anyone?
Is your job one?
Hit me with that one more time.
Your job?
I have some bad internet here. I can't hear you. Okay. Looks like I might. Hit me with it one more time. I see you.
How much money you make, your job.
Okay. Perfect. Yes, exactly. Sorry, I couldn't hear you there. So how much money you make, your income, and even your employment type. If you have a more secured, if you work for the federal government, you're going to have a more secure job than if you worked on, say, the railroad. One of my buddies works for the railroad, and it seems like he's furloughed at least once a year for a couple months. He gets laid off. They're not busy enough to keep running. So, how much money you make, your income level, and your employment type play large factors or play key roles into the interest rate that you'll be approved for. Some other things, obviously your credit score. That's going to be probably the biggest factor in acquiring a loan. Typically, they run about 680 plus. If you're 680 plus, you're prime, good to go for credit. Now, kind of with these COVID times and everything, and with how the housing market is here in Texas, you're going to want to be a little higher. But 680 is kind of the general, the standard. If you're above that, you're in good standing with the bank, and they'll loan you money. Now, if you're below 680, it's going to be tough to get a loan from anyone. And that's kind of where you go into those private loan companies that we were talking about the other day, loan sharks. We'll talk more about those later on today. So credit score, your credit history. They're going to make sure that you make your payments. If you're not paying your credit card bills, if you're not paying your bills in general, obviously a bank's not going to lend you anything. So your credit history plays a big role into that. The size of the loan is going to be somewhat big. I think it kind of plays more into the employment type and income in regards to loan size, but they will look at that and take that into account. Also the loan term, 30 years as opposed to 5 or 15. They're not going to make as much money on the 5 or 15-year loans, so they would definitely rather hand out 30-year loans, make more money off of you. And then the loan type, and we'll kind of get into the loan types today, just a little bit. But and getting the interest rate, it's all based on your pre-approval. You'll kind of figure out what interest rate you are approved for when you get your pre-approval letter. And can somebody besides McKenna, I don't want to be having to call people out. Thank you, McKenna, for answering that first one. Can anybody, after going through law of contracts and everything, can anyone tell me what the importance of a pre-approval letter is from a bank as opposed to pre-qualification letter?
Doesn't a pre-qualification letter like not mean anything at all?
Yes. Yeah, exactly. So yeah, pre-qualification, you can pretty much go into any kind of mortgage company or like the mortgage apps, Rocket Mortgage, anything like that. You can say, I'm Aiden Riley. I work as the CEO or the CFO of Tesla. I make 10 million a year, and I can apply for. They'll give me a pre-qualification as the CEO of Tesla. Now, when you get a pre-approval, obviously they're going to start. They're going to actually look into your income. They're going to look into your financial status and give you like an accurate estimation of the loan type that they'll be able to provide, the loan amount, the maximum loan amount, and the interest rate. So, yeah, pre-approvals, especially when you get your license, you're going to want to make sure before you start showing clients homes, you're going to want to make sure they're pre-approved. I've had clients that I accepted and took on and went and showed them 4 or 5 different properties over the span of a couple days, and they were like, "Man, I'm really interested in this one that we went and saw this day." I was like, "Okay, sounds good. Can I get your pre-approval letter? And can I get in contact with your lender to kind of find out the logistics in the offer we're going to write up?" Because they had told me, "Yeah, we're going to write up. We want to submit an offer on this and do it for this amount." And I was like, "Well, that sounds great. Can I get your pre-approval letter?" Now, this is when I first got my real estate license, so I was young and innocent, and I thought everybody was legit. And once I asked for the pre-approval letter and everything, they completely ghosted me. It's very key that before you take on new clients, you can show them one property. If they call and they're very interested about a certain property, yes, you can go show them that. But after that, you're going to want to get a pre-approval letter signed because they could end up being approved for $250,000, but they're making you show them $400,000 homes. Well, that's just a waste of your time, your money, your gas. I mean, it's just a headache to deal with. So pre-approvals are very key once you get into the game, and you'll realize that pretty soon. I mean, another way of talking about pre-approvals and why you want to get them early is you'll have clients where you do ask them and they'll ghost you, and then you'll have other clients where you'll ask for a pre-approval and they'll say, "Well, I don't want to do that yet. I just want to find a house. Once I find a house, I'll go get pre-approved, and then we can submit an offer." Well, kind of something to combat that is, right now in the market here in Bryan College Station, like it's been said multiple times in this class, the typical turnover rate for a house on the market is around 3 days, which is insane and not normal. But in areas like Austin and DFW, they're on the market for 30 minutes to an hour. So if you are out showing houses and your clients find their dream home, "Oh my gosh, I want to buy this home right now. I'm going to start talking to the lender. I'm going to go get pre-approved." Well, by that time in this market right now, by the time they get pre-approved, they get everything submitted, and they get the approval letter back, it's going to be way, way too late. So that's kind of a way you can combat it now on your clients not wanting to be pre-approved. If they're not, you can tell them, you're looking out for their best interest, which is your job in the first place. You're looking out for their best interest, and if we want to make a move on something today, you're going to need to be pre-approved. Like today, I'm talking to one of my clients, trying to help them find a house. The market's so crazy right now. They're in DFW. They're not even. I sent them some new properties that popped up in the market within the last 24 hours, and without even seeing the property, obviously in person, we went ahead and submitted an offer on one of the houses, and then we're going to rely obviously on that option period to back out if they have any defaults or if they have anything that they feel is wrong with the property. But we're going to submit an offer, or we have already submitted an offer, and then we're asking for a showing on Thursday. So pre-approval is key, especially right now in times where homes are on the market for anywhere from 30 days to 180. Obviously, it's not as important, but you're still going to want that pre-approval letter so you're not out here wasting your time. In talking about negative amortization, and a lot of these points throughout this slideshow we'll kind of just hit very briefly. Again, like I said multiple times yesterday, and I'll say multiple times today, you don't need to know the specifics of everything in these PowerPoints. You just kind of need to know the general idea. So in negative amortization, this is typically where the lender or the borrower kind of requests the lowest payment possible. So they're paying on what would be regularly amortized. Like we saw in that video, they kind of get the minimum amount, and what that does is those payments will not even cover all the interest that's on that property. So I mean, anytime your clients try to get into, they want to secure a loan and they want to pay the least amount possible. We'll talk about multiple other types of loans that are like that in this PowerPoint, but if they're trying to pay the least amount possible, you want them to be wary of that, because if you're paying on not all of the interest, if you take one of these negative amortizations and they're not paying all of their interest on every monthly payment, well, the rest of that interest is accruing along with the principal and compounding interest continuously, so it's going to keep growing. So that's just something you always want to keep your clients away from if they ask. Generally, they won't, but just something to keep in mind. Buy down plans and points. Loan officers or banks will offer borrowers, an incentive. If you bring an extra $10,000 in cash at closing, we'll drop your rate from 5% to 4%. There's a lot of people that will ask, well, shoot, can I bring 50,000 then and drop it from 5% to 0%? Obviously, the bank's going to say no. They just kind of do it as an incentive thing to make it more feasible on your part. Typically, they'll only do around 1 to 1.5% in buy downs because, again, like I've said multiple times, interest and interest payments, that's how these loan companies make their money. So it's very important to them. And then amortization, obviously, it's equal payments throughout the life of the loan. At the end of the loan, it dies, and you'll gain title of that property. We'll kind of talk about amortization a little later in this chapter. But like he said, when you take a fully amortized loan, at the beginning you're paying what seems like 90% interest and 0% principal. But you are paying down that principal gradually, and it's not compounding as much interest as it originally would. So you definitely want to do that. I equals PRT. So this is finding simple interest. You will have some questions on your real estate exam about simple interest. We're not going to go into any of the math on that today, but you do want to know that it is interest equals principal times the rate and this is time. It's typically in months. That T is not years. So we'll go into that later when we get into the math of things. I don't like how they put that in this part of the slideshow. But then talking about term loans and amortized loans, like I said, term loans are going to be those. If you're going to go term or amortized, and your client's going to ask you which one, the more tempting one is going to be term because it's going to be lower payments at the beginning. But on those interest only, it's typically used for if you're building a property or trying to flip a property. So if you're just going to buy a property, move in it, fix it up real quick, and then turn it around and sell it, obviously you don't want to be paying on the principal amount of that loan. You don't actually want to be paying for that house at all. It's kind of like a wristband to an amusement park. You just want to be able to go and use the rides, but you don't want to have to own the whole park. You just want to go and be able to use it. So it's used for flipping houses and kind of for investment purposes. You can go in, um, pay for 6 months, pay only the interest on that loan. Kind of rebuild it up, put a little money into it, and then resell it for a profit, and then hand that loan off to somebody else. So um, it's typically only those kind of two settings for investing in and flipping, where you would try to use short-term loans, like an interest only. And we'll go into balloon payment later on. A balloon payment is very similar to interest only as well. Interest only kind of refers to eventually you will gradually start taking on that principal, but a balloon payment is if you take a 15-year balloon payment. Well, for 15 years, every month you're going to pay only the interest on that loan. You'll never pay anything on the principal. And then when that last payment comes up, that loan amount is going to be due in full. So if you take 250,000, you're going to be paying, 750 a month for 15 years or whatever, 14 years and 11 months. Well, on 14 years, at 15 years, that last payment, you're going to have to owe that 250,000. So it's definitely not recommended you shouldn't recommend it to any of your clients who are looking to buy a home and stay there. If they're looking for a property for investment purposes or to flip, it is something you can bring to their attention. But again, I wouldn't advise them on anything. I would let them talk to their lender and let them advise, because you are not licensed in that area, so you don't want to get in trouble there. Going over to an amortized loan, like I said, it's equal payments all the way through. You're going to be paying principal and interest, majority principal at the beginning, and then like you did on that 30-year loan, at about 6 years in, you'll start paying more principal than interest. But this is definitely the way to go. You don't want to be doing any of these short-term payments, and then your clients be upset with you. They're going to rather see this. It is going to be a little higher at the beginning, but that constant amount is going to be a lot easier to swallow in their eyes. So talking about more loans, fixed rate. This is kind of where we'll get into the multiple different kinds. Fixed rate, this is definitely the loan that you want to get your clients into. If you have any say, you want them to do fixed rate over adjustable rate, graduated payment, any of those others. A fixed rate is, like it says in the title, it's fixed. So if it's 2.89 like it was in that video, well, then they're going to have a consistent interest rate of 2.89% monthly, as compared to like a little bit below it, an adjustable rate mortgage. They will, lenders will try to sell borrowers on ARMs and try to get them to sign into one with baiting tactics, basically. They'll kind of say, hey, look, I can get you signed on to this loan for 2.5%, where everything else is originally, around the 3.5 to 4% area. I can get you in at 2.5%. And, the majority of people, including me, if I see that, well, I'd like to hop on that and see, kind of see where it goes. And then once you start looking into the specifics of the loan, you'll realize that, it's typically, you'll have that 2.5, 2% range. You'll have that fixed for about 2 years. And then after 2 years, they'll jump up a couple percent. And then at about 10 years, they'll jump up a couple more percent. So you really want to be careful on talking to your clients about adjustable rate mortgages. They can be very dangerous. They'll be very tempting, but they are dangerous in the end, and they can really put you in some financial trouble if you if you're not careful in what you're getting into. So back to the fixed rates. This is obviously, like I said, what you want to get your clients into. They'll escrow the funds for property taxes and insurance. The bank will. The reason they do this is they want to make sure you have the money to be able to pay your taxes and your insurance, because if you don't, obviously if you don't pay your taxes, your property taxes, that's the very first thing, the first thing, the tax man, you never mess with the tax man. No matter what you do, they're going to come, they're going to take your house, they're going to foreclose on it, they're going to get their payments. So they'll hold those funds on a yearly basis for property taxes and insurance. Obviously, the banks likes to hold the home insurance as well, because if they're giving you a loan for $250,000 and you live in a flood zone, and it just so happens that your house floods and gets completely washed away, well, they know they're insured because they keep that in escrow and they know it's being paid. The last thing they want to see is you defaulted on your insurance payments and didn't notify them, and your house gets swept away. There's nothing, securing that house. It won't be paid for. They're just going to have to eat that loss. They obviously don't want to take that hit, so they're going to keep all that in escrow. Going about ARMs, we pretty much went over that. The graduated payment mortgages. Now these are fixed rate mortgages also, but they're basically an ARM, but they also set out the specific times of when the payments will increase. So over the life of the loan, the percentage will stay the same, but you start out at a very small amount paid monthly, and you gradually work your way up to larger sums. So obviously they have a cap on this, but it's very dangerous. Payments can get up to, I think it's $5,500 a month. So if you have clients who really, if you have a client who comes to you and says, oh, well, I'm pre-approved for any of bullet points 2 through 5, you're going to want to ask them why. That should be a red flag to you. You're going to want to ask why they're doing that, and maybe try and talk if they do have a good reason and it makes sense to you, then okay, they can go with it. But you're going to want to try to steer them towards a fixed rate loan. Obviously, it's going to be at the beginning, the payments are going to be more, but they're the same throughout the life of the loan. All these other ones gradually increase, and it can really put your clients into some tough financial situations, some sticky situations, and then they're going to be upset with you because you didn't warn them about that. So you just want to be aware of that. The home equity loans, or the HELOCs, this is once you've built up a percentage of equity in your house, you can borrow a percent of that equity. You can borrow against that. This is far extreme. If your clients ever ask if they should do this, I would recommend you say no, unless they have an investment opportunity that's going to give them 100% return within a few days. They're very dangerous. Typically what it's used for is, a couple will be in $50,000 in credit card debt, but their house and the land they live on in the house is paid off. Well, what they'll do is they'll they'll take out a line of credit on the equity they have built up in their house, pay that $50,000 off, and boom, you're good. Well, people tend to, once they do that, they tend to kind of abuse that power, and it's dangerous because you're borrowing against a secured loan. Your home is a secured loan, and credit cards, stuff like that, they're not secured. It's always best to just deal with the credit card people, try to do some credit repair on your end, and take that route, because taking out home equity loans, I've seen situations where They see that they can take out money against their home. They only take out, 20,000 to pay off student loan debt or credit card debt, and they kind of see it as a revolving credit card that they can use against their home. And it's just very dangerous. So I would try to steer them away from that. And then a reverse annuity mortgage. This is just typically is dealt with elderly people, senior citizens who need money and have kind of ran out of their retirement or whatever. Obviously, they own their home, they own their property. So what they do is they'll take monthly payments from the bank, and the bank will basically buy that equity back, buy that equity that they have in their house back from them. So they'll get monthly payments in the amounts of whatever they signed for at the bank. But they're continuously losing equity in their house. They're losing the ownership. So if they were to want to sell, obviously they wouldn't be able to. So that's very dangerous as well. If there's anybody who's young and wants to do that, obviously, again, if they come to you and ask if they should, highly advise against it. Do as you please, of course, but I try not to as much as I can. So yeah, here's a little more going into the adjustable rate mortgage. Like I said, there's adjustment periods, and those periods kind of typically go. The first one usually goes, that initial rate lasts for about 2 years. And then the note rate, it'll kick in after about from years 2 to 5, and then they'll just keep gradually getting bigger. At year 10, they usually have the third hike up, and then from there on out, you could be paying an interest of, you could go get suckered in for 2.5%, and then after 2 years, you're paying 5%. Well, then after 10 years, you could be paying 7.5%, 8%. And obviously, at that point, it would have been a lot better if you had just signed it to 3.89 or 4% fixed for 30 years. So just, stuff to keep in mind. That's just kind of how it works. They run off their own indexes and margins. That's the lender's requirements. So they're all separate. They have different margins that they have to meet per loan. So that's all put up in those terms. Like I said, there's a rate cap. I don't know what the rate cap is right now for adjustable rate mortgages. I would think it's around the 12 to 13% mark, which, you can imagine if you were able to sign for even, 4.5%, it's going to be a lot better than paying that. That obviously the 12%. That'd be miserable trying to pay down. You're gonna be like a very high majority of your income is going to be put into your house payment. So you want to try to stay away from that as much as possible. Obviously, along with the rate cap, there's a payment cap based on your income level. So that'll all be determined by the lender. Prepayment penalties. There are prepayment penalties for adjustable rate mortgages because you can't, if you sign on for that 2.5% for 2 years and you make a good amount of money, you come into some money, and then before that first hike up kicks in, you take in the $200,000 and you're like, all right, I want to pay my principal off. I want to be done. The bank's gonna be pretty pissed at you for that because you just kind of screwed them out of some money. So with adjustable rate mortgages, there are some pretty costly prepayment penalties. So you want to be careful for that. Obviously, with an ARM, you can convert it to a fixed rate, and with any term or with any kind of loan type, your clients will be able to kind of switch back and forth and in between multiple throughout the whole process and throughout the life of the loan. They will pay. There are benefits from just in jumping from a fixed rate to an adjustable rate. There are benefits in some circumstances from jumping to an adjustable rate to a fixed rate. Again, we don't need to know all that information. We'll kind of get into it a little bit, but that's mainly for the lender to deal with. So they are convertible. The only thing you want to know is before you start telling your client to maybe, look into a different type of loan, they will be paying quite a bit in loan origination fees. Each time a contract is written up for a loan, it's going to cost them money. So they need to be careful in switching back and forth. Conforming loan products, PITI. Does anybody remember from the video what PITI stands for? What those 4 letters mean? I always said if I ever became a teacher that I was not going to be the dude who called out people because I always hated that guy. PITI.
I'll say
Okay.
it's principal, interest, taxes, and insurance.
Exactly. Yeah. So perfect. Thank you so much, Gio. Yeah, the general rules. When applying for a loan, these are just the basic rules that they have. Like he said, your principal, your interest, your taxes, and your insurance are not to exceed 28% of your monthly income. So that's the payment. Basically, your note payment on the house can't exceed 28% of your monthly income. The PITI plus debt, it can't be more than 36% of your monthly income. And then obviously, like I said, borrower must have good credit. And typically the range that is acceptable nowadays is around that 680 range. And borrower must have stable employment. Obviously, like I said, they're going to make sure where you say you work is where you work, and that there is some backing that you have, and that you will have stable employment. Because if you're out of a job, obviously it makes it, those $1,200 payments when your monthly income goes from, $5,000 to zero. Those $1,200 payments are going to be a lot harder to make. So they're going to want to make sure your employment is stable. The maximum loan limits are set by the FHFA. Now, in talking about jumbo loans, these are loans that exceed that limit set by the FHFA. And if they do, these are kind of clients where we're talking about, they want to buy $1 million to $3 million homes. And so if they do qualify up to with these standards right here, they will be able to secure a jumbo loan. Now, with COVID going on right now, and like our economic situation we're in as a country, jumbo loans are pretty hard to come by. Banks are very wary to hand those out. So if your buyers were going to want to buy $1 million house, they can't just have good credit nowadays. They have to be making a good sum of money too, because the banks are very cautious on who they're giving it out to. And then the underwriter on the loan has flexibility in applying the guidelines. So obviously 28% is kind of the standard, but if you have a good relationship with your lender, and they speak highly of you to the underwriter, then that underwriter might give you a little leniency. The only thing that you can't do is the same in regards to kickbacks. You can't go to the underwriter and say, hey, approve this amount, and I'll slide you some money, or vice versa. That's kind of how that whole 2008 financial crisis happened. So you won't have any contact with the underwriter at all. I don't even know an underwriter's name here in the area, or that have done any of the loans that I've worked with. But they do have flexibility in these guidelines. So, and then private mortgage insurance, like you talked about in the loan, or in that video, private mortgage insurance it's going to be required through FHA. If you have less than a 20% down payment, it's not required afterwards, but some still get it. The majority don't, because who wants to pay an extra $100, a couple $100 a month or whatever it is for securing the loan to the bank, but just to save themselves of liability somewhat. This protects the lender, like I said, in case of default. So the banks love it. It's just an extra fee that they're taking on. But generally, the general public, not big fans of it, because they're paying an extra $100 that they don't have to. This is obviously paid in addition to the PITI. And then, the termination of PMI, it can be terminated after that 20% mark is hit. But obviously, banks don't like to do that. Banks like to keep collecting fees. So at 20%, they don't terminate PMI until about 36, anywhere from 32 to 36%, depending on the bank. And the reason they do that, obviously, is they like to keep on taking those fees and make more money. So this is where you can come in and be a good real estate agent. And after you've helped somebody buy a house, and you've done the calculations on one that'll hit that 20%, set a reminder in your phone, hey, this person has hit 20% on their loan payments. Ask them, just call and check in on them and see how everything's going. And we recommend that, even if after you're done working with a client, call them at least once a year, call them around once a year. And you don't even have to talk real estate with them. Just call them and see how they're doing. Because, I don't know about you. I haven't personally bought a house yet. But I know people who have bought houses, and their real estate agent still reaches out to them or sends them little goodie bags for their birthday or whatever. And they obviously say, if I'm going to buy another piece of property, if I'm going to do anything regarding real estate, I'm going to go back to that person. So call them every year or so, check in on them. And once they hit that 20%, you're talking to them, hey, you hit your 20%. Are you still paying on that private mortgage insurance that you're having to buy? 99% of the time, they're not even going to realize it, and they're going to say yes. And tell them to get in contact with the bank and try to save you a couple $100. Well, they're going to think they're going to love you more than you'll ever know for that. And even if they don't buy any property or sell any property in the future, they'll be sure, more than sure, that to refer you to their friends. And I'm going to be honest, being in the business, it's hard to generate your own leads. The best way to do it is to have people like you and have you referred out. If people like you and you're referred out, you're just going to be completely bombarded with clients. And you can obviously pass those off, and you'll take a referral fee of whatever you decide with the agent you hand it off to, 15-20% of their commission. So that's always a good thing. Just be nice to everyone, check in on people constantly, because you want those return clients, and then also the referrals that they give out. So, and then obviously you do have to have private mortgage insurance for split or piggyback loans. You don't deal with these at all, really. So I don't know why they added in the PowerPoint, but they did. We'll go ahead. Refinancing on conventional loans. Like I was just saying, you're not going to make money by helping your clients refinance, or if they are struggling by referring them to a good lender that can help them refinance. But if you do the referral and you get them with a good lender who gets them a good rate and a good price, they're going to be sure to give back to you anytime they make another purchase or want to sell. So obviously, talking about there's the home affordable refinancing program, the streamlined modification program, the home affordable modification program, and then Obviously, that one, the HAMP goes into, it can reduce interest rates as low as 2%, extend the life of the loan to 40 years, kind of ease the amount of payments or ease the size of payments and extend that loan, defer a portion of the principal until the loan's paid off, kind of swipe out a percentage of that principal until it's paid and then bring it back in. Or they can elect to forgive the principal. I've never heard of a situation where that would happen. So yeah, but the streamlined modification program is kind of the same thing. It's typically when somebody is 90 days, up to 90 days delinquent on their payments. Typically what they'll do is they'll streamline payments down and extend the payment term like it does in the HAMP up to 40 years. So it's just another way to refinance. That's kind of the basics of how refinancing works. Not too much detail, not too crazy. Subprime and predatory lending. Subprime obviously is those C and D students that you have in your class. They are graded on A, B, C, D, and then paper. Obviously A being the best and paper being the worst. Now don't get this confused with when I say your prime loans are your A and B students. That's completely separate from this. Subprime, these are classifications of subprime loans. And then obviously this, some of the things that come with subprime loans are higher interest rates, higher fees, and banks will take them. Will depend whether or not they take them based off the risk. So if they're not able to secure, they are a subprime borrower, and they're not able to secure a loan from a bank. That's kind of when we get over to these predatory lenders, where they charge unnecessary rates and fees. They'll flip loans. They'll inflate appraisals to get them the most money, make sure they're lending out the most money, and charging the higher interest rates and putting their clients in a hole, their borrowers. They're really high pressure sales tactics. They'll, when you walk into like a loan company that does these predatory practices, they'll try to sign you on for 20%, being your interest rate. And if you're not sure and you kind of want to walk out the door, well, if you walk out the door, whenever you come back, it's not going to be 20%, it's going to be 27%. They're very harsh, they're very mean, and like it says, they're predators. They feed off of the people who don't qualify for good loans in the first place and just put them deeper into a hole. There's a lot of red flags that come with them. And this will send us into our second video that talks about predatory lending. It's short, 6 minutes, but it just kind of goes into 2008, kind of what happened in predatory lending and how that put a lot of people down in the hole.
Minnesota, 85% of all mortgage loans taken out last year in 2006 were cash out refinancings, where the borrower refinanced and in part took cash out of the mortgage, cash out to pay for things like credit card debt, healthcare debt, to buy new cars.
My father and mother bought their first home with a subprime loan, so it worked out just great. But subsequently, my father developed two problems. He developed diabetes, and then he had a beat up old car. So when he refinanced, he bought a brand new car.
that partly fueled the borrowing situation. And what fueled the mortgage crisis, I think, is you got to look at the outset, there's an unlevel playing field. An unlevel playing field between the borrower on the one hand and the mortgage broker on the other. Anybody who's attended a closing knows the blizzard of paperwork, all the forms put in front of you, the 30 documents in mice type print. And it's very difficult for borrowers to understand that kind of legalese, and the on-level playing field has been one which scrupulous brokers and lenders have used to their advantage.
These are unregulated mortgage brokers, often on their own. Unregulated mortgage lenders, not banks, because banks have some degree of regulation. And they created the trouble.
So in New York, we have over 300 mortgage banking entities. We have over 2,400 mortgage brokerage firms. Each of those entities combined have over 40,000 individuals who originate mortgages.
The lender is all for the broker making a lot of loans and really turning a blind eye to any abusive features of those loans, because the lender is going to make the money selling the loans off as a commodity. So it's as if, the interests of the borrower aren't really part of this frame at all.
The banks are keeping this thing alive. They are buying these loans and pumping money into this system, which is keeping this thing going. In fact, I would argue that they're more guilty than these folk on the ground running around trying to con people.
The Minnesota legislation does is a couple of different things. Number one, it puts a duty of agency on the mortgage broker to not treat the sale of a mortgage like you would the sale of a used car, but to really look out for the borrower's best interest and make sure that the borrower is actually going to benefit from the type of loan that's being recommended. In addition, it bans these so-called stated income loans, which have been a big area for abuse, where the broker would make a loan not based on verifying evidence, but simply based on what the borrower states on the application to be their income and assets. And that's been a problem area for abuse because it allows brokers to make up income that people don't have.
I especially want to say thank you for banning stated income loans. I heard of a situation about a month ago where someone who works as a maid at a hotel in New York, her information was changed to she was a domestic engineer. And her stated income went from, I think she makes about $1,200 a month, to somewhere around $5,000. Somehow domestic got taken off and engineer stayed. And her mortgage, which started out at about $1,700, will reset next year. She'll be one of the 2 million people that have it reset. And it should be somewhere around $3,700, $3,800.
And then another third main point is on these teaser adjustable rate mortgages, the mortgages where people are lured in with a low initial rate only to have that reset 2 or 3 years down the road, that lenders have to make sure that you can qualify not just for the teaser rate, but also qualify for the higher rate when it goes up. I think in the past, opponents on the other side of the aisle have been able to kill the legislation by saying, oh, this is just an issue that affects our core cities. And so we really made a concentrated effort at the hearings to have suburban people with, $700,000 homes who were in foreclosure attend to say this is something that affects everybody. It's something that affects the constituents of both political parties. And you can't just isolate it by saying it's a inner city problem. Having real live people tell the story, I think, was also incredibly helpful. These issues can get kind of esoteric. But we made sure at every hearing we had the live witnesses who were really harmed. And we made sure that the people that we had present were people, again, from all parts of Minnesota. People on perhaps our side of the aisle or the consumer advocate side of the aisle tend to be fractured. They tend oftentimes not to have a uniting force. They tend to all be on the same page and all have the same beliefs, but not necessarily speaking with one voice through one bill. And here, I think one of the reasons we were successful is we really did have everybody who wanted to see this legislation get together, have a consensus.
The function of the Marketplace of Ideas series is not just to have a speech about the dangers of predatory lending or the impending doom of the foreclosure crisis, but instead to search, as we did, for the models that can actually prevent predatory lending and prevent a foreclosure crisis.
So yeah, that's just a little bit about predatory lending. It's a huge, huge problem. Obviously, back before 2008, caused a whole lot of people to go into quite a bit of financial trouble. So we try to obviously warn clients of ours as much about that as much as possible. The last thing you want is for them to have to get a loan and get torn up financially because of something that you recommended. So always just keep your eye out when talking about lenders or to lenders, and make sure they're legitimate people, because there are people who are very slimy and just want money more than anything. So, and then variations in format, different mortgages that you can get. An open-ended mortgage obviously allows for future advances, covers personal property, and is typically used for farmers and builders. Now, can anybody answer? I mean, do you really want personal property being attached to your home mortgage or your home note? Do you really want, your cars or, in the case of farmers, their tractors? Do you really think they want those tied up in their in the mortgage for their property? Just give me a thumbs up or a thumbs down. Since it's a yes, no. Yes, exactly. Yeah, no, you definitely don't want your personal property being tied up in these. But unfortunately, that's how open-ended mortgages are. These are, like I said, farmers or builders. They allow the borrower to go back and borrow more, for farming. There's a lot that goes into farming, cost-wise. New tractors, new supplies, all of that kind of thing. So they typically get open-ended mortgages where they can keep borrowing against it and then paying down once the crop they harvest. So yeah, that's pretty much it about open-ended mortgages that you need to know. Construction mortgages are they disperse by draws. What that means is, when you go to, if you're building a house and you get a construction loan, you need $15,000 to do the foundation and lay the pad. So you'll get the first $15,000, you'll pay for that, and then you'll take those receipts back to the bank so they know that you are actually using the money for the construction of that site. And then once you need the slab poured, they'll give you money for that, and then so on and so forth with framing in the wood, and then the electrical, all the way through building a house. Obviously, there's a lot more components to that, but they come out in draws. They don't just give it all in one lump sum. They want to make sure that you are actually building this house. And this is typically given to builders, obviously, so they know that their loans that they're handing out are going to the house, and then they will be repaid back once the house is sold from that builder. They're holding a completion bond, and it's a standby commitment for permanent financing. Nothing really big on those points. That's just kind of extra stuff, extra fluff that they threw in under construction mortgages. That's pretty much the basics around that. Some more variations. Blanket mortgage, leasehold mortgage, package mortgage, manufactured housing. These are more different types of loans that they offer, and we won't go into detail on any of these. You don't really need to know in detail what they offer through these. You won't. It won't be asked on your test. What the any specific questions about these. So you do just kind of want to know the general idea of the loans that banks offer, and this is them right here. And then mortgage participation, partnership of mortgages, large project financing, Ginnie Mae pooling. This is another fluff slide going through the finance test. None of it has to deal with this slide, so I'm going to kind of leave this off. It's just a bunch of stuff that I haven't even had to deal with yet, and my career so far as a real estate agent. You know, as I've said hundreds of times, and I hate to repeat myself, you don't need to know the specifics of everything. You just need to know the general idea. So this is a page we will spend a little bit of time on, the tax impacts in mortgage lending. You know, installment sales. An installment sale is kind of, it's a situation where, you know, if Corey's going to build a house, she hires a builder, and the builder gives her an estimate for $300,000 to build the house, buy the land, and everything. Well, she's going to go take out that loan for $300,000, give it to the builder. Obviously, his profit is included in that, so you know, she's continuously paying that $300,000 note to the bank. Once the home is finished, she moves in. She loves it. It's her dream home. But, you know, 6-7 years down the road, the land around her, the development around her, ends up being a lot nicer than originally projected. And so that $300,000 home is now worth $800,000. So obviously, if you're paid $300,000 for a home and it's now worth $800,000, even if it is your dream home, screw it. I mean, you're gonna sell, make that $500,000, and walk away and go build another home. So what this does is, you know, if you're a married couple and you sell that home for you make $500,000 in profit, and it is your primary residence, then capital gains, like it says here, capital gains tax, you know, which is usually referred to in stocks, the money that you make in the stock market, but this is based off of the equity in your home and your home value going up, skyrocketing. If you're a married couple and you profit $500,000 and that is your primary residence, that $500,000 is free of federal taxation, which is awesome. You love to hear no taxes on, especially on $500,000 in profit off of a house in 10 years. And obviously you won't hear this a whole lot. You won't hear about this a whole lot, but it's something good to know, just in case you do, if you do have property with how properties are skyrocketing right now in Texas. We're kind of running into situations where, you know, a home sold in 2018 for $220,000. Well, it's being put back up on the market for, you know, $290,000 to $320,000. So, you know, taking that into account, you're going to kind of want to just know the general principle of this, and obviously they're going to need to talk to their lender and their finance guy, their financial advisor, to see the best way to go about this, but it's just something good for you to know of. And then the IRS Section 1031 exchange. This is a very interesting thing. It's for investment properties, property held for productive use. Say in the situation, I own an investment property and it's not renting out like I want it to. I'm having tenants move in and out constantly. It's not in a good, either it's not in a good spot, or it's just kind of run down and I don't want to put any more money into it. It's not making me enough money to invest more money into it. Well, what you can do is you can do a 1031 exchange and sell that property with the intent of buying another investment property, and that the money that you make off of that sale will not be taxed through the government. The kind of the only stipulations here, it says it must be of like kind, and the property, and unlike property, something higher or lower, something that's not generally in the same price range is going to be considered a boot. They're going to boot it out. They won't allow it. This is a very, if you run into an investor a real estate investor, you'll deal with it. If you work here in the College Station area, the Bryan College Station area, obviously half of our population is college students moving in and out annually. So you deal with a lot of investors here, and this is something that some investors do know about, but some don't. And if you save them money, save them taxes off the sale of one property into buying another, obviously they're going to love you and want to continue to work through you in their property acquisitions. So we're just going to finish up class here. It's just a 12-minute video talking about the 1031 exchange and the kind of the good characteristics of it and the benefits that it has as an investor. So we'll finish up with this movie and we'll be done for the day.
To discuss how to do a 1031 exchange, what it is, why you should utilize this strategy, and a couple of things you should keep in mind. Real estate markets are evolving constantly, so it's important to review your portfolio frequently as new opportunities become available and as your financial objectives shift. If you're a real estate investor and thinking about either buying or selling property, it's important to be familiar with the 1031 tax-deferred exchange, which allows you as the property owner to sell one of your properties and acquire a different property while pushing off or deferring capital gains taxes. Capital gains taxes can reach up to 20% for those in the highest income bracket. So this tax deferment tool can be an effective investment strategy as you buy and sell properties. So first, what is a 1031 exchange? A 1031 exchange gets its name from Section 1031 of the IRS Code, which says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business, or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. That's quite a sentence. So to put it simply, this code allows you to avoid paying capital gains taxes when you sell a property and invest those proceeds into a property of equal or greater value if you locate and purchase that new property within the designated time frame. Let's say you bought a property years ago for $200,000 and put up a 20% down payment, which was 40 grand. You decided to sell that property, which is now worth $400,000. And so after paying your mortgage and all expenses, you walk away with $100,000. Now you can buy a $500,000 property with 20% down without coming out of pocket. Anyone who owns property held for business use or investment purposes qualifies for a 1031 exchange, while personal residences and the majority of fix and flips do not qualify for this type of tax deferment. So why would an investor utilize the tax 31 exchange? Well, there are actually a number of reasons that make 1031 exchanges very attractive to investors. Number one, improved cash flow. If you have a high equity property or one that is free and clear, it may be a good time to take that equity and invest it into a property of higher value where you can improve the cash flow. The 1031 exchange actually allows you to reinvest the proceeds of your sold property into a newer, more expensive property. So you could use that equity that you built up in your first property and place it into a different investment that will offer greater cash flow without you having to pull out that cash. Number two, easier management. If you have acquired multiple assets over the years, such as a portfolio of single-family homes, you may want to exchange them for something that requires less hands-on management, such as a well-managed multifamily property. We've had a number of clients that started their investing careers in the single-family realm that we were able to help 1031 exchange into large commercial properties that not only improve their cash flow, but allow them to afford full-time property management at a much lower cost. Number three, estate planning. If you are estate planning, having a well-managed property will be far less of a hassle for your heirs to deal with, since they may lack experience in real estate and would struggle with the property management responsibilities. You may also desire to consolidate multiple assets into one, or take a single asset and divide it over multiple properties. For example, if you own a large office building and want to pass your cash flowing asset down to your grandchildren, it may be difficult to divide a singular asset among a handful of people. Instead, it would be better and less complicated to have multiple properties that you could assign to each grand job. Number 4, diversification. Don't put all of your eggs in one basket. It's very beneficial to have a diversified portfolio. You're allowed to utilize the 1031 exchange to purchase in different regions of the country or into multiple different types of assets. If you own a single retail property, you may be nervous for the future of the retail market as a whole. So it would be wise to reposition your equity in this singular asset and distribute it across multiple markets. That way, if one isn't performing adequately, you aren't left high and dry. Number 5, buying a vacation.
If you own any kind of a business making $75,000 a year or more in profit, I'll show you a taxation home.
That's right. The 1031 exchange actually allows you to invest the proceeds from one of your investment properties into a vacation home that you and your family can enjoy. But of course, there are a few rules for this type of exchange as well. The property being relinquished must have been held for at least 24 months in order to buy a vacation home and defer those capital gains taxes. You must also rent this property out to another person for 14 days during every 12-month cycle. You can, however, rent those 14 days out to a family member as long as the rental rate is at fair market value. Now, here's how to do a 1031 exchange. There are a number of rules to follow when executing a 1031 exchange, so here's how to do it. It's extremely important for you to be aware of what you can and cannot do according to IRC 1031 and the IRS tax code in order to ensure that you receive the full benefits of a 1031 exchange. As a general rule for enjoying full tax deferral, a taxpayer must reinvest all net exchange proceeds and acquire another property with the same or greater amount of debt. So after you've sold the original property, you have a 45-day identification window. This transaction must adhere to the allowed time frame of the IRS Section 1031 code in order for your exchange to receive those benefits. Within 45 days of selling your asset, you must identify a like-kind replacement property for these assets. So what does like-kind mean? Like-kind property simply means that real estate must be exchanged for real estate. You cannot sell real estate and buy an airplane. You can exchange a vacant piece of industrial land for a Class A office building or trade 2 single-family homes, as long as they were investment properties, for a retail strip center. But you cannot use a 1031 exchange to do something like buying shares in the stock market with the proceeds from a quadplex. The property must be held for investment or business purposes and cannot be used for personal uses or immediate resale, although what determines an immediate resale is somewhat of a blurry line. If it is clear that there was no intention to flip immediately, you could potentially trade the property the day after your purchase if your initial intention was to acquire the property as an investment, although those situations are rare. Now, there are a couple of rules that you have to follow when identifying your replacement property, so let's dive into those. The 3 property rule. The 3 property rule allows you to identify up to 3 properties as potential replacements for your sold property, no matter what their value is. Selecting the maximum amount of potential replacement properties is almost always the best course of action, so that you have multiple options in case one property ends up not working out. The 200% rule. The 200% rule allows you to assemble 4 or more potential replacement properties as long as their total value does not exceed 200% of the value of your sold asset. Now, after the identification period has expired, you have 180 days to close on that new property. Within 180 days of closing on the sale of your previous asset, you have to complete the purchase for the replacement property. During the 180-day time frame, you are also allowed to do construction on the property or make improvements as long as they are complete before the 1031 exchange deadline. Any improvements made after that 180-day period are viewed as personal property and will not be considered a part of your exchange. Now, there are also a few variations of the 1031 exchange. The most common, which we've been discussing, is often referred to as the delayed exchange, but most people just call it the 1031. You could also do a simultaneous exchange where both properties are traded at the exact same time in the same escrow office, a reverse exchange where you acquire a new property and then sell your original one, or an improvement exchange, which can be used for heavy renovations or new construction. But what happens if you identify a property of lesser value and you can't find anything else? Well, that's called a cash boot. If your replacement property is of lesser value than the original asset you sell, the difference can be taxed. The presence of a mortgage is allowed on either side of a 1031 exchange, but if the mortgage on the replacement is less than the property being sold, this can also cause a cash boot. Now, this cash boot can also be created by some fees associated with real estate transactions, but fees such as broker commissions, attorney's fees, title insurance, premiums, escrow fees, and filing fees, those are included in the list of fees that can be paid with exchange funds. Now for the fun part, reporting to the IRS. Once the exchange is complete, you will need to report the exchange to the IRS using the Form 8824 in the same year in which the exchange took place. Form 8824 will ask you to provide information including property descriptions, relationships between parties, property values, profit and loss, cash received, and more. Now, you're probably wondering to yourself,
Dogecoin has had an unreal last 12 months. Elon Musk, Mark Cuban, Snoop.
who handles the reporting to the IRS and how would you identify these properties? Well, that's where qualified intermediary comes into play. The qualified intermediary, or QI, works on your behalf as the facilitator for a 1031 exchange. They receive and hold the proceeds from the relinquished property and then use those to acquire a newly identified property. Therefore, it's very important that you choose wisely when it comes to qualified intermediaries. Unfortunately, there isn't much government oversight in how QIs are regulated, and there aren't any educational or licensing requirements. Even the slightest error could disqualify you from receiving the benefits of a 1031 exchange, so it's wise to choose a QI who is knowledgeable and experienced in Section 1031 of the IRC. Some questions to consider when choosing a QI. How big is the company? You may want to consider working with a larger team so that if there's an emergency, there will be more than one person that will be able to assist you. It can be devastating if something happens and your 1031 exchange falls through of no fault of your own. Does the QI you are choosing carry errors and omissions of fidelity insurance? If the intermediary makes a mistake, you will want to make sure you are covered. Fidelity insurance will cover any financial loss incurred from fraudulent activity that is performed by the intermediary company. You should also ask them how your funds will be handled between the sale of your old property and the purchase of your new one. Unfortunately, there have been cases of separate funds being commingled and used for investment activities, which can leave sellers down the creek without a paddle. You will want to make sure that your money is only being held for the purposes of executing the exchange so that you will have a smooth transaction when the time comes to purchase that new property. So before you get started, it's critical to consult with your legal and financial advisors, along with your real estate agent and all other appropriate parties that will be involved in this process. Time is of the essence in a 1031 exchange, so it is crucial that you have a solid plan in place and that you communicate this plan to all of those with whom you'll be working with before you move forward. Now, investors are able to successfully complete a 1031 exchange on their own. However, this process is very complicated and involved. So it is crucial to work with experienced people that will be able to lead you through each step and ensure that you will execute it successfully. So that's all we have for how to do a 1031 exchange. If you're interested in learning more about...
All right. So, yeah, I mean, 1031s can be very beneficial if you're looking for investment properties or trying to switch over. It could be, a killer. I mean, you're not having to pay taxes on the profit that you make on a property and buy a better one. Obviously, like I said, and he said as well, it can be more expensive, but it must be like kind. Yeah, that's gonna be pretty much it for the day. Does anybody have any questions regarding the lecture at all from today? Everyone's good. Alrighty, I'll stop recording.